Hi, Steve Van Metre here, and welcome to your Monday Night Premiere. We take about 15 minutes every Monday and Wednesday night, trying to make sense of markets. Yeah, they don't make much sense, but we will attempt to make sense of them. All right, so I'm kind of excited because today is Hedge Fund Monday, where we take a look back at how hedge funds were positioned in the futures market and why I'm even more excited than normal, because some of their positions don't make a lot of sense when you see them bullish on one position and they're bearish on a position it's not an opposite trade. They should be bullish on both. It's kind of like being long the dollar and long gold. Normally you would want to inverse that position. You wouldn't want to be long one, short the other. But what I'm really interested about today is the amount of Treasury bond shorts the hedge fund managers have put on. And when you look at how much the bond market has moved since the hedge funds have really come back and re-shorted the bond market, and you look back at the last time they were this heavy in shorts, the last time they made a huge move in bond prices. This time they're not making a very big move, which is validating what I've shared with you for the last couple months, that this recent elongated pattern, you can either say in bonds or in yields, depending on which one you're looking at, is a continuation pattern, meaning yields are going to go lower and bond prices are going to go higher, because we can see it based on the speculative positioning. So I want to get into that. Plus, I also want to go back and look at just a few charts from last Friday, and then we'll get into some actual charts, just kind of refresh ourselves over what we learned Friday, because, well, I dumped a lot on you. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation by selling a security, financial product, instrument, or to participate in any particular trading strategy. This video was prepared by Steven Van Metre, own personal capacity. The opinions expressed in this video that I'm going to do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial. All right, so with that out of the way, let's go to the NASDAQ McClellan Summation Index, probably one of the best proxies of liquidity on the market. And if you can't find this on stockcharts.com, the symbol is $NASDAQ. You can look at it every day. Emerging markets also do a pretty good job as kind of giving you a direction of liquidity, but you can see it's stalling out here. And when liquidity stalls out, it does eventually move the other way. You can just see how bullish the market is. It wants more liquidity. It wants to go higher, but it's just not getting the liquidity that it really wants. Let's go back to last Friday, and look at the durable goods new orders as a leading indicator. And I just wanted to pick a few of these just to go over, just kind of refresh where we were. And you can see that this is commercial industrial loans on a year-over-year basis. And you can see when commercial industrial lending contracts, it usually means that, especially late cycle, that new orders are falling, because how do new orders get paid for? Well, they usually get financed. And here you can see going up after the dot-com bubble, new orders rose, but there wasn't much financing demand, and finally financing demand caught back up, and you can see new orders fell going into the great financial crisis. Followed. Now you say, well, wait a minute, commercial industrial lending, which is in red, is following. I said, well, if you look on a 3-month basis, instead of the year over year, which I cannot chart here through the Fred database, I don't allow it. You get the idea that when lending contracts, new orders are soon to follow. And let's take a look at, this is one I came up with over the weekend. I dug through the Fred database, not something I normally do, but there are, I believe, 12 regional Fed banks, all of them that report conditions or manufacturing conditions, services conditions on a monthly basis. I thought, oh, perfect. I'll go through and I will aggregate all of them together. Well, it turned out there was only 3 of them. Texas is omitted from this because Texas data really is more of just look at the price of oil. You know, when the manufacturing sector is booming in Texas, it's because oil prices are up. And when oil prices are down, you can see that the manufacturing sector is down too. So I cut that out because it really didn't add any value, but I took the Philadelphia district and the New York districts and I averaged them together against new orders, and this is their new orders. Again, every Federal Reserve district does publish their new orders. They just don't put them on the Fed database. I don't know why. But you can see that new orders from The manufacturing surveys in the Fed districts are pointed lower. Again, it's noisy. It moves around a lot, but the trend is lower there. And you can look at institutional money funds. This is money flowing into large money market accounts. So you're thinking, big brokerage accounts, IRA accounts. That's where you find institutional money markets. You tend to not find institutional money markets at your local bank. They have regular money markets. So you can see now the money flow for institutional money markets in red is shown inverted. So when it's going down, it means money is flowing into money markets. And you can see both ahead of both of the last two recessions, the money flow into money markets led a contraction in new orders both times and by a sizable length. And here you see institutional flows into money markets headed lower there too. And what does that tell us? It just tells us that new orders are likely headed lower. So money that was going to fund new orders is now going into cash and sitting there. And as a preview for your update on Friday is the 4-week moving average of initial jobless claims, which may be one of the best ways to find out on a weekly basis what's going on with the actual payroll or the jobless rates and payroll, because the monthly non-farm payroll report is so inaccurate. I know everyone's really excited about the report that came on Friday, but over the last 12 months, 46% of all the jobs created were fictitious self-employed jobs created by the Bureau of Labor Statistics without any evidence that those jobs actually exist or not. I hate to say it, it's one of the worst data points the Fed uses, but they love it. So here is the moving average, 1 to 4 week moving average of initial jobless claims, and it's shown inverted. And you can see that when new orders go down, that the jobless claims, which shown inverted, go up. They're shown going down, which is correct. But notice in 2016, jobless claims were not going down. They were not rising. I'm going to say this backwards, but anyways, they were going the right direction. How about that? We'll just leave it at that. And normally they follow the new orders down. So we should have seen an increase in jobless claims. We didn't. And we also did not see when new orders went up a decrease. It went up, but not like it has in the past when you look over here. So all to say is new orders are headed down. What does that tell you for initial jobless claims? They're probably headed up, or in this case, down. Is it due to the trade war? Probably. I mean, most likely. Businesses want to believe that it's over, but it's not yet. Anyways, as we look into how hedge funds are positioned, thanks to Hedgeopia, we can see on the 10-year, there's an increase in short positions, but this isn't really what's interesting to me. What's interesting is the 30-year bond futures. So 30-year bond futures are now trading at the shortest position since they were roughly back when interest rates were at their 3-year peak or 4-year peak, almost 3.5-year peak according to his chart. So back when 30-year yields were around 3.2%, right in here, 3.3, 3.2, and then they went way down to 1.9 from that same level. Now look where we're at right here. We're at the same short position, but we haven't had a big move. Remember, that big move in yields went from 2.6 all the way up to 3.4. Here, we went from 1.9 to 2.2 and change. Not a big push higher in yields for as much the large short position we're seeing. So what this means is the smart money is taking the opposite end of this trade and they're wanting it. They're not letting interest rates spike higher. They're actually coming in and absorbing this. So imagine we saw this move here, right? Go from roughly 3.2 to 1.9. Where does that tell you the next move is going to go when the market adjusts lower and the hedge funds become long? It means 30-year yields are going a lot lower because the smart money is taking the opposite of this trade. And again, as I've said, this here is a bull flag or a bear flag if you're looking at yields. This is a bear flag in yields, meaning yields are going lower. On bond prices, it's a bull flag, meaning bond prices are going higher. So I love that because obviously, as most of you know, that's exactly how I and my clients are positioned. Hedge funds remain very long oil, hoping to get a big surge in oil prices like 2008. I don't think they're going to get it. They are now increasing their shorts on the S&P 500 by a little bit. Still very, very long gold, even as gold is slowly breaking down from 1,500. They're hoping that it's going to get up there, but at some point we should see a big drop in gold. That should be, in my opinion, what the big leading indicator before the next big move in gold will be when the speculators get out. Because when we look at the money multiplier one of these days, you'll see you can almost predict the next major move in gold just based on the money multiplier alone. NASDAQ, they're backing down on their long positions, and they are now long the Russell 2000, which is interesting. Being short small caps, they're now long small caps. You got me on that. US dollar, they're backing off their dollar shorts. Now, this actually starts to make their dollar longs. I'm sorry, not off their shorts. They're backing off their dollar longs. If you're long gold, you probably want to be short the dollar. So it doesn't make sense why they were long dollar, why they are long dollar and long gold together. It can go, dollar and gold can move up together, but it's just not all that common. And they're still very, very short volatility. I mean, when volatility does get unwound, these short positions, that means stock prices are headed lower. Okay, so we've got a few minutes to go look at some charts. Oops. And let's go over to the S&P 500. Just barely above its opening price from Friday, but still there's a big gap, and there's a gap here. There's lots of gaps that need to get filled. But let's look at Treasury yields. So let's go back to 2018. So here is where the hedge funds were in that heavy short position, and then all the way down. So what does that tell you? That this move here is a bear flag, that yields are going lower because the smart money is adding to their long positions while the dumb money is building bigger short positions. So hedge funds think interest rates are going up. The smart guys think interest rates are going down. Well, you saw who won that bet last time, and you can guess who's going to win that bet the next time. But notice that this big, here, not 18. We need to go way. This is, I'm looking at the wrong chart. Here, 18, interest rates went from here all the way down to here. There's your bear flag in yields. I'm sorry about that. You see it right here, kind of looking like a flag, an upside down flagpole with a flag hanging out here. So this is telling us we got another big move down in interest rates to come. You're talking, if we see the same move, you're looking at least 1% lower. I mean, you're looking 30-year yields close to 1% or maybe a little lower. And that's assuming there's still no recession. You've got this big pattern here, and that is visible in TLT, where you can go back to 2018. You see this big move higher off of speculators getting out of their short positions. You see this beautiful bull flag, and we held resistance today. So after a gap move higher, sellers are right in control here, but you'll notice that during the day, there's mostly buying going on, which is kind of unusual. You would expect to see prices fall, but there are definitely people in the cash market buying against the speculators in the futures market who are selling. So right now you see this big move of volume. All of this is obviously selling this down. And then today you have small volume. The sellers were in charge, but they didn't get much for it. So these speculators have gone from here to here on a large speculative short position, when in the past that short speculative position went from up here way down into here. They made a lot more money on this move here before they got crushed. They're making nothing. This is not a very big move for the amount of risk they're taking at all. Let's take a look at ags. Ag commodities today touched overhead resistance. As most people know, I'm bullish on the agricultural sector, and it needs to kind of push through resistance here. Doesn't seem to be reacting to any of the trade war news at all. It just seems to be reacting to the fact that crop conditions aren't as good, and there are crops under snow still. So we'll see. We won't get the final results of the harvest until sometime in January, because the USDA continues to kind of brush over the recent weather events. But nevertheless, I like that move as well. It's got a long ways to go, but a lot of short positions to push its way through on the way up. But I still think the big move is still yet to come in the bond market. I like that it held support here on TLT. Needs to get a little momentum as the short sellers run out of juice, but you can look at the futures market and see they're very, very short for a very small move, and it won't take much. Perhaps it won't take anything more than the tariffs coming Sunday night at midnight, which we have to believe at this point are still on unless China can find a way to talk themselves out of it. I don't think they're going to pull it off, but hey, they've done pretty well so far getting President Trump to delay. I don't think he delays this time. Anyways, we'll be back Wednesday with a update on what the Federal Reserve is doing. They're meeting tomorrow and Wednesday. We will expect no change in policy, but you never know. I'm Steve Van Metre. Thanks for watching. See you Wednesday. Bye now.